Hi, everyone. My name is Jason Choy, Senior Portfolio Manager at InvestNow, and welcome to InvestNow's Meet the Manager series, where we look to provide investors with a bit more insight into the investment philosophy and approach of the specialist investment managers we have on the platform. Today, I'm joined by Nicholas Bagnall, Founder and Chief Investment Officer at Te Ahumairangi Investment Management, one of the 30-plus specialist investment managers we have on the InvestNow platform. Nicholas is here to provide a bit of an overview on Te Ahumairangi. Nick, thanks for joining us today, mate.
Nice to meet you. To talk to you. Yeah.
So, Nick, could you provide us with a bit of background on Te Ahumairangi, how it all started, and what exactly it is that you guys specialize in?
So I started Te Ahumairangi in early 2020. I'd been at ACC for 26 years, and when I left ACC, I set up Te Ahumairangi to manage global equities using the same approach that I used at ACC. And that approach very much emphasizes lower risk investing, of particularly avoiding the riskiest stocks and really focusing on the rest of the equity universe. We only manage global equities, just one strategy.
Great, and kind of touching on that history you have with the ACC, because it is very rich, and dating back to your days as the chief investment officer overseeing one of the biggest investment funds in the country. Could you kind of tell us a bit more about the track record, because it is almost legendary in the industry that you have, and the track record you have of managing money there, as well as the relationship that Te Ahu has with the ACC today?
Okay, yeah. So ACC did have has a very good track record. We had 18 years in a row of beating our benchmarks. That was at the total reserves level, which and I was as chief investment officer, I was overseeing a whole bunch of people managing portfolios and different asset classes, and heavily involved in asset allocation. I started the asset allocation approach that's used there, and selecting external managers. But for the last 10 or so years, or since March 2011, I'd been directly managing a global equity portfolio using the same approach we use at Te Ahumairangi. That was taking about half of my time, but the rest of the time I was overseeing a team, getting involved in asset allocation, dealing with all the distractions you get being part of government and in a government organisation. So it's refreshing at Te Ahumairangi to just focus on global equities and not have all the distractions I had as CIO at ACC. Sorry, the other part of your question, we continue to manage money for ACC. So when I left, they asked me to continue managing the global equity slice that I was managing for them, and so we did do that, and they in fact had an exclusive arrangement with us for the first year that we set up as a firm. That was sort of from August 2020 through to August 21, and then we were free to take other people's money. And we launched the Te Ahumairangi Global Equity Fund in November 2021, which is the fund we've got on your platform.
So the global equity strategy that you run for ACC is very much in line with the strategy that you employ at Te Ahumairangi. So it's great to know that retail investors can get access to the same pedigree of investment strategy that was traditionally only available to the likes of massive investors like the ACC. So and the strategy that you employ is certainly unique, right, Nick? Could you kind of talk us through the investment strategy that the fund uses and how this differs to your traditional kind of global equity fund?
Yeah, what's particularly unique about us is that we focus on lower risk investing. We emphasise investing in low to average risk companies and avoid investing in the riskiest, most volatile companies in the share market. And that means we are unlikely to own shares in companies like the Teslas and Nvidias, the ones that are up the most when the market's up, but down the most when the market's down. There's a good reason for that. One is there's two good reasons. One is the obvious one, is that by investing in sort of, we're investing in the boring, predictable companies rather than the exciting, volatile ones where no one knows the future. And that does mean that our returns tend to be more stable over time. If you look at a graph of our unit price, you'll see it's a lot more stable than other global equity funds. So, reducing volatility is a benefit for investors in itself. They're less likely to incur a big loss in a fund like ours than they would in one that sort of chases the growth stocks. But the other thing, I've actually got a graph here that shows this. If you graph the long-term performance of stocks by their volatility, the most volatile stocks have produced much worse returns than the average and low-risk stocks. So we're really about avoiding this part of the market, and this is where the Teslas and Nvidias are. So undisciplined investors tend to like to chase excitement. They buy what's in the news headlines or what shows up as being the fastest grower or the cheapest stock or whatever. And those exciting companies tend to be the most volatile ones, and they, as that graph showed, they produce the worst returns over time and add the most risk to your portfolio. So we avoid them, and we try to add value in the other 80% of the market. And we are, we are going for the best return for risk wherever we're investing. We try to find companies where we can be reasonably confident about the long-term outlook for, profits and cash flows and valuations, and they tend to be in the low to average risk category.
So what you're saying is that your fund isn't necessarily growth or value orientated at all, right? It's almost got like a contrarian type approach to it. So at the moment, obviously, growth and your Nvidias and Teslas of the world have been going gangbusters past couple of years. But it's almost for your fund, you've been able to be quite successful by almost going against the grain. And could you kind of walk us through the thinking and how that's kind of translated to performance?
Yeah. So I mean, certainly over the life of the fund, we've tended to be value tilted. So because that's the market we're in at the moment. So we believe that there are a lot of things about companies that would help you predict performance if no one else was looking at them. But the challenge in markets is that everyone's looking to do essentially the same thing. They're trying to add value to pick performance. And if you look at what everyone else is looking at, it's unlikely to work. You'll do better if you look at characteristics that are meaningful for a company that aren't attracting a lot of attention from other investors. And in the last few years, we've been in an environment where a lot of people are chasing growth, and that makes it really hard to add value by selecting for growth. So we've tended to be more value tilted. Sorry, what was the second part of your question?
So I think an interesting thing I kind of read about what you guys do is you look for good, not necessarily great, right? But then irrespective of that, your performance has still been quite strong relative to this benchmark, right? So can you kind of walk us through how that works? It's a bit almost counterintuitive, right, Nick?
Yeah. I mean, it's the market. Yeah, people are more likely to notice companies that are great in one respect than above average in everything. And those are the company that's growing the fastest or is the cheapest or something like that is likely to attract a lot of attention. So we tend to look at a range of things in evaluating companies, and we know companies that have more certain futures are less likely to surprise at the extreme upside. They're less likely to be five baggers, which go up 400%. They're more likely to just deliver slightly better than average returns. But we've picked enough of them, and we're very disciplined about doing negative screening across companies we hold. So not holding stuff where there are red flags, and that's worked. It has been an environment. Well, certainly we launched at the end of 2021, and the first year or so of our fund was a great environment for our style. It was a year where the market went down, high risk stocks underperformed, low risk stocks outperformed, and value stocks outperformed, and all of those things helped us. So that really helped us in the first year. Over the last 18 months. It hasn't really been an environment that should naturally help our style, but we've still managed to keep up with the market, even though it's been, we've had some slight headwinds in terms of the market environment, and that's just been from the bottom up, picking good stocks and avoiding mistakes.
It's great to hear. And probably the other unique aspect of your fund that I'm keen to touch on, Nick, is the cost side. So kind of despite Te Ahumairangi being an active manager, your fund is still very cost efficient, coming in at fee levels lower than even some of the passive options in the market. Nick, could you kind of walk us through Te Ahu's philosophy around cost and how you've managed to provide such strong value for investors?
Yeah, very happy to. I think a lot of funds out there are overpriced. I think when you offer a service to people, you should offer it at a price where they're likely to get better value than what you charge. And adding value to a portfolio isn't easy. If you look at studies, there are very few managers that add much more than 1% per annum on a pre-fee basis. So when you've got a lot of funds out there, charging 1.2 or 1.5% for active management, I think it's unlikely over the long run that they'll deliver enough value to justify the fees, and certainly very unlikely they'll deliver enough value that the client gets as much benefit out of it as the manager does. So I would like, in 10 years' time to look back and think, ideally, we've beaten the benchmark by 1.5 or 2% per annum, and we've charged 0.6, and the client's got a bit more out of it than we have. And we are very aware that there are passive options that are as cheap as like 0.15, and I want to be able to look investors in the eye and say, hand on heart, I think you're better off investing in our fund than investing in a passive vehicle. And I feel much more confident of delivering value to investors if we start at 0.6. And look, I mean, we had a luxury of having ACC as the initial client. So I think you've sort of got a catch-22 with some fund managers where they want to pay their bills from day one, and they don't see enough funds under management, so they charge a lot. Whereas we were close to paying our bills at day one because of that, ACC as the initial client, and so we could set a relatively modest fee on our fund, and it has grown significantly over 3 years. We're over 390 million sitting in that fund now, so we're doing very well even with a modest fee. So very happy with that decision.
Yeah, that's music to a lot of InvestNow customers' ears, that there's actually strong value. You don't necessarily need to pay an arm and a leg to get active management, because obviously the downside of passive, although it may be cheap, you won't be able to actually leverage the skill of skilled active managers like yourself, Nick. So kind of, a follow-up question to that is, despite kind of the storied history you have of managing multiple different asset classes with ACC, Te Ahu at the moment just really focuses on just the one fund option, right, being global equities.
Yeah.
Has this been a conscious decision, or could you plan? Is there potentially scope to get a low fee active option for potentially different asset classes in the future?
Not other asset classes. I think you do better if you just focus on the one asset class. And I think a lot of people managing global equities in New Zealand, it's almost been an afterthought. They've started off with something like New Zealand equities and added asset classes along the way, and we don't want to. I want to keep the organisation simple, so it's one team focusing on one strategy. We might, we probably will offer a currency hedged version of the fund at some stage, but it's still the same underlying strategies. But we won't add other asset classes to the mix.
And that makes a lot of sense, because you guys really want to be specialists and masters of your trade. So really appreciate all the insights that you provided today, Nick. It's really great to see the amazing growth you and your fund have been able to achieve in a relatively short amount of time. So if anyone out there wants to check out and learn more about Te Ahumairangi, please do check out the Te Ahumairangi landing page on InvestNow, where you can invest into the Te Ahumairangi Global Equity Fund. Thanks everyone for your time, and thanks again, Nick, for your time and insights today.
Thank you for your questions.
Cheers, guys. Catch you next time.